Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Hey everybody, welcome to Wealth Unfiltered. This week's episode is wealth and taxes. It's all tax strategies and how to manage them. So we're very excited because today we are not home. We are actually filming in Vegas. We're here for the NMHC conference and Chris has meetings set up all week long and we're very excited about what this week has to bring. But more exciting, we had a really wonderful guest on the podcast. We had Brandon Hall. He is the CEO of Hall CPA. So this week we were able to ask questions like the biggest tax mistakes that people make. We asked him about, tax strategies to help mitigate liability. So this is literally walking into tax season. So you don't want to miss this episode and we're so excited to share it with you. Today, we're super excited because we are talking about taxes and wealth. So who better to have than a CPA? And not only is he a CPA, but he is the CEO of his own company. And I would like to welcome Brandon Hall. Hi.
Hi, thanks for having me on. I appreciate you inviting me, and I'm excited to be here.
Yeah, I'm very excited. As with most of our guests, Chris has already met you, but for me, this is my first time getting to have a conversation. So I appreciate you coming on the show. Today, we want to start by asking you a little bit about your background. And then honestly, we want to find out what kind of inspired you to choose real estate as your focus.
Sure. So I'm the CEO and founder of Hall CPA, also known as the Real Estate CPA. We service about 1,000 clients or so nationwide. They are all niched, or they're all real estate investors. So our niche is real estate. Not most of my team, I shouldn't say that. A lot of my team, not most of my team, invest in real estate themselves too. Almost everybody on my team wants to invest in real estate, even if they aren't already. So it's kind of cool because we've attracted a lot of accountants that are just drawn to real estate naturally. And it kind of is a nice competitive advantage for us and our clients because we can talk to them about taxes and accounting and also investing, which is really neat. But what originally drew me to it was, this is back in 2014, 2015. I was working at Ernst & Young, which is a Big Four accounting firm, and just didn't want to work for somebody else, wanted to try doing something on my own. I was actually investing in real estate myself at the time because I was trying to replace my income. And so I bought a 3-unit property and it was great. It was a home run deal. I still own it today. At the time, it cash flowed like $700 a month. So I went and, spreadsheet mathed it all out and realized that, and again, I've since learned a lot, but at the time, my thinking was I need 20% down and I'm going to buy 3, 4, 5-unit properties. That was my plan. So when I spreadsheet mathed it, it was like, oh, I'm going to have to do this for like 20 more years to replace my income. And that's just not going to work for me. So around the same time, I found Bigger Pockets and I was replying to a bunch of people's questions on Bigger Pockets and just sort of got drawn into this tax. I realized people were asking tax questions. There weren't many people at the time providing tax answers. So I just started chiming in. I was a CPA at the time and got a lot of joy, a lot of energy by helping people. And that immediate feedback loop of thank you so much. This was so helpful. I was getting that on Bigger Pockets, but I wasn't getting that from my day job. Day job, you get a once-a-year performance review. But daily, I was getting locked into this Bigger Pockets forum and just getting the dopamine rush going, getting addicted to it because of that positive feedback loop that I was creating for myself. And that just sort of snowballed into taking on clients. People would reach out, ask if I was taking on clients. I just started saying yes. I had no idea how to price, no idea how to build, no idea really how to run a business, but I figured that along the way. Stumbled a lot, but today it's pretty rock solid. So that's what
you were an accountant, right?
Yeah, but that was good. And it was great seeing a lot of being able to network with and meet a lot of real estate investors. Taught me a lot about how to invest my own money, and that was one of my probably main inspiration points to do this specifically target real estate investors.
So you've been doing this for about 10 years now?
Yeah. So I went full time Q3, end of Q3, 2016.
Okay. That's awesome. So you've obviously had extreme growth. You're at conferences, you're talking to all sorts of people, you're on podcasts. So I guess for me, with the 10 years of experience and exposure that you've had, some of the biggest questions that I think people want to know from you in particular is what are some of the biggest like tax strategies that are most common mistakes that people are making that you're seeing?
Yeah, it's a great question. The most common mistake is partial asset dispositions. I mean, when we review tax returns of potential clients that are coming into us, I would say 9 times out of 10, the accountant does not book partial asset dispositions correctly, and that is true even of accountants that bill themselves as real estate accountants. The partial asset disposition stems from the 2013 tangible property regs and basically says that if you replace any major component of your property, you can deduct the cost, the remaining cost of the component that has been torn out of your property. So, for example, if I buy a property today worth $500,000, and 2 years from now I have to replace the roof, and that roof replacement costs me $20K, most accountants and even real estate accountants will just add $20,000 to your balance sheet and they'll start depreciating that over 27 and a half years. The problem with that approach is I'm now depreciating two roofs. I'm depreciating the roof that came with the property that's embedded in that $500,000 cost. And I'm also depreciating the new roof that cost me $20,000. What a partial asset disposition allows us to do is go in and remove the old roof. So we would go in and assign a value to the roof that no longer exists to ensure that you're only replacing one roof. But when you do that, you get an immediate deduction for the remaining cost of the roof that you pulled out of the property. And that's why, also why we price our compliance a little bit higher, because we're looking for these types of optimization strategies on an ongoing basis. We can talk about real estate professional status, short-term rental loophole, all that type of stuff all day long. Everybody's talking about that. TikTok, Instagram, Twitter, you name it. And those are like the sexy things that definitely pull you in and get your attention. And they are amazing strategies. Yeah. But it's this ongoing optimization that, in my opinion, really makes or breaks your wealth compounding ability over a 10, 20-year horizon.
Do you find that there are other strategies that are just being either underutilized by other accountants or by your people you see coming to you?
The underutilization is definitely, like, partial asset dispositions hits that underutilization pretty much perfectly. That's the big one. But the other ones, I mean, cost segregation studies, bonus depreciation, I know you guys know what that is, but you'd be shocked at how many real estate investors are coached out of claiming bonus depreciation. Their accountants will literally elect out of bonus depreciation, and there are very rare circumstances where that actually makes sense. So there are times where that makes sense, but it's rare, very rare, and it can really set the client up for failure at some later point. So we just see like a misunderstanding of like the net present value function or calculation related to cost seg and bonus depreciation, and then really just a misapplication of the passive activity loss rules is probably the biggest thing. We've been helping with a lot of audits over the past 12 to 14 months or so, and it's been just a huge spike. I mean, from the time that I started my firm, 2016, to pretty close to the end of 2023, we had maybe like 3 or 4 audits. Today we have 16 open audits, and we get about 4 to 8 requests a month for audit help. And these 16 audits, I think one of them, maybe 2 of them, is our current clients. Like, we prepared the return, so we're helping them, and the others are from accountants that just like ghosted the client or just said we can't help you. But with those, it's a misapplication of the passive activity loss rule. So just not understanding material participation, not understanding how real estate professional status actually works, how that short-term rental loophole actually works. Again, it all sounds amazing, right? And it is amazing. They are great tax strategies, but what's the saying? It's like an idea is worth basically nothing and execution's worth everything. You see it play out. A pound of prevention is worth a pound of cure. We can keep going with the idioms all day long, but that's what we're seeing too with the audits. So the audits that we are finding a lot of success with are where people had great documentation, whether or not they understand the passive activity loss rules, they happen to be on the right side of it. But the audits that we are seeing people lose, and our role in those audits pretty much becomes build the best case possible, and then try to get penalties abated for the client, save them 20 or 30,000 extra dollars by not having to pay those penalties. That becomes our role in the losing audits. But those losing audits, I didn't understand material participation in real estate professional status, how those hour differentials are the same or different. I didn't understand the hour buckets that I should have been participating in or with. I booked a lot of research time, a lot of education time, a lot of travel time, a lot of investor time, right? It's the whole like, oh, you can do your bookkeeping and manage your property manager. Well, that time gets destroyed in an IRS audit. Like it just doesn't count. But that's the type of advice that's proliferated social media and that we've seen from CPAs that charge like, 30 grand for tax advisory, but their clients are getting hosed in audits. So it's just really understanding how the passive activity loss rules work and then having great documentation to support it. And even if you understand it all, if you don't have the focus to manage the admin headaches that come with running these strategies, like the documentation, for example, you should really just not run these strategies. There are other strategies you can run. That's part of what we do whenever we're advising clients is like, they'll come to us, I want to save $100,000. Okay, well, based on your situation, you can. Now tell me about your life. Like, do you like recording everything? Oh no, I hate that. I would never do that. Okay, well then you can't do this. So let's find something else to do that is low hassle, that enables you to just claim it and not have to worry about it. So that's the uniqueness that is tax planning. We could just say everybody does real estate professional status, but the reality is that a lot of people don't actually have the ability to manage the admin hassle that comes with that type of a strategy.
Yeah, and Chris, you have a question from our investors specifically about what he's talking about, right?
Yeah, absolutely. And I think you've nailed it, right? Everyone, sees the marketing out there for reps and how powerful it could be to offset your passive and active income. Who do you think is the avatar that should consider getting reps? And who is the person that really should just, find another strategy, work with someone like you to, like you said, like achieve the same goal, but with something more realistic?
Yeah. So the people that should look at real estate professional status, those people are typically married. One spouse earns a really high income, the other spouse does not or stays at home, or they are in real estate as a business. Like they're a broker, they're a property manager, they're a developer, they're a flipper, they're a general partner of a syndicate or a fund, and they're the sponsor, the main sponsor, not one of the co-sponsors. So those are the folks that it typically makes the most sense for. Real estate professional status was originally meant to help people that were running a real estate business. So the issue was when the passive activity loss rules came out back in the 1980s, they didn't have real estate professional status didn't exist when these rules came out. So what happened was these rental losses one day, like just think about it, like if next year all of a sudden you were never allowed to claim your rental losses again, that's what happened in the 1980s. One day you could claim them, and then the next day all of a sudden there were these new rules called the passive activity loss rules that prevented you from claiming your rental losses. But what was happening was even people that were in real estate full time could not use their rental losses, which they argued is tangential to their real estate businesses. They couldn't use their rental losses to offset their regular income, but physicians could use the losses from the equipment that they purchased for their surgeries and all their care to offset their regular income. So real estate professional status was added to the code in the early 1990s to close that gap and make it a little more fair for people that were running real estate businesses full time. So the people that should do it are people that are running real estate businesses full time, or are people that receive a lot of their income from their landlording. They spend a lot of time in their landlording, or they're high income earners and one spouse is staying at home and could qualify and then offset the other spouse's income to a degree. Those are the people that should do it or should look at doing it. The people that should not look at doing it are ones that are in like the lower tax brackets. And I'm not going to define that because it's different for everybody, right? Like we have clients that would never accept 10 cents on the dollar in terms of a reduction in their taxable income. And we have other clients that would do that all. We've seen other clients that would do that all day long. So, it's a personal decision what the value of the dollar is for you. But Other people that should not do it are people that work full time and you're also trying to qualify yourself as real estate professional status. The IRS just never going to buy that. And we get a lot of physicians, for example, that will say, well, I'm 2 weeks on and 2 weeks off, or 1 week on and 1 week off. So I've got half my time to dedicate to real estate professional status, which is true. However, the 1 week that they're on, they're working like 20-hour shifts.
Right.
And so that still gets you to a full time, 2,200 hours a year that you then have to surpass with rental real estate. And it's just gonna be really hard to do that. So we're typically looking at real estate professional status as people with lower time commitments to their day jobs.
Got it. And then with the short-term rental strategy, I know you've spent a ton of time on this in the past and have a lot of videos on your own podcast and things like this on kind of mastering that. Same answer, or would this be a strategy for someone that maybe has a spouse that isn't working? This is something that they could employ to kind of fast track getting reps.
Yeah, great question. So short-term rental strategy is totally different. There is a special workaround in the regulations to Section 469, the passive activity loss rules, that enable you to claim your short-term rental tax losses against your regular income without having to qualify as a real estate pro. You do have to materially participate in the short-term rental. And there are rules to doing that, rules that are often, we find, violated or not seriously taken into consideration. But there are rules to being able to execute that. And your average period of customer use has to be 7 days or less. So you can't have like midterm rentals or anything like that. It's got to be an Airbnb that's cranking through, or VRBO that's cranking through people. But if you can do that, then your losses from the short-term rental will be considered non-passive. You don't have the real estate professionals as blocker. So that's why that short-term rental loophole became such a massive strategy over the past couple of years, is because people realized there's a workaround here where I can invest in real estate and I can extract those losses from the bonus depreciation without having to qualify as a real estate pro. And the significance of that is real estate professional status. You can't qualify for real estate pro if you have a full-time job, because one of the tests to qualify is spend more time in real estate than your day job. But with a short-term rental, if I don't have to qualify as real estate pro, then I don't have to worry about that test, meaning that I can do this even though I have a full-time job.
Got it. And the last question I'll ask you about this, because this is a question that comes up from our investor base a lot. Someone that, is active in real estate and that is their main business, and they're looking at transitioning from active to passive. They're just, they're in their 60s now and they want to get onto the passive side. Is there a window where, because they're still actively managing and that's their main role, as they transition into passive, can they kind of use this strategy to really unlock a period that's powerful?
Oh yeah, 100%. And this is where really good tax planning comes into play. Like if you're, as you, I think everybody listening to this and listening to most real estate podcasts, the goal is to transition out of my day job at some point and use rental real estate, this portfolio that I've built, to cover my income that I need to live, plus ideally. As you move, as your total income starts to shift away from being primarily your day job and starts to balance out with the real estate portfolio, and might even start to be overweight real estate portfolio, meaning the real estate portfolio itself is generating most of the income, that requires really good tax planning, because we can go in there and we can help you understand exactly what years you should be looking at running a cost seg, what years you should be looking at material participation. We'll help you understand the passive activity loss rules. But it becomes very strategic at that point. It may make sense to go and spike the return this year with those losses from a short-term rental, or it may make sense to do it next year, or it may make sense to do it in 3 years, or it may make sense to do a retroactive cost seg study and apply it to a prior year. So it just kind of depends on where you're at in that life cycle. But I guess in summary, my non-answer is that you should, as your income shifts more towards that real estate portfolio, the tax planning that you can receive becomes even more valuable.
Great. No, I appreciate that, because I think this is probably the biggest question that folks ask. Really appreciate those answers.
Yeah, no problem.
And I know Chris has some other questions, but before that, because I'm very interested in when you say tax advice. So we were talking earlier before we actually got on the show, and you were discussing about how there's like a tax planning piece, but there's also like the advice that you guys offer. And so like when you offer advice to your clients, is this like annually for the entire year? People can pop in, ask questions. Like how does that piece work for your company?
Yeah, so clients that work with us, we have an advice. We don't just do tax returns, so we do tax returns and we call it advisory. But basically, there's a you receive an advisor that you always get to work with at the firm. That might be the same person that's preparing your tax return. It might not, but that's what we have built at our firm, is to make sure that everybody always has an advisor that they can go to. So yes. So to answer your question, those advisors might just be answering some questions, much like you would use Google. They might also be putting some numbers down to paper and really helping you visualize it and understand what year to apply certain things in. But the idea is to say every client has the ability, has that relationship with our firm and the ability to leverage us however they see fit. And of course, we offer a lot of suggestions as well as to how the relationship should look and what you should be expecting to get and what the timing of things looks like. So it's not just up to you to define it, but everybody gets an advisory relationship with the firm, and it really helps just with clarity. Because what we've figured out is essentially clients have, what are you really looking for when you're looking for a CPA, right? Whether you're looking for tax advice or tax preparation, you're really looking for increased clarity, reduced anxiety, and buying back your time. And so that's what we try to focus on, right? We want to increase your clarity, we want to reduce your anxiety, we want to help you buy back your time. Like yes, you could probably go figure out how to do all of this yourself with AI and TurboTax and all that type of stuff. But do you want to spend that time in the process? And that's the question that a lot of people ask, and then they go no, and that's what we're really helping people do. So buyback time, reduce anxiety, and increase clarity.
Would you say there's a specific size portfolio where you would say like definitely get a CPA, or do you feel like it doesn't really matter?
Yeah, honestly, it's a tough question. I mean, firms will have, like, our firm has ideal client profiles, right? Meaning that we know if you fit this box, we can really help you. We work with people outside of that, though. And when we work with people outside of that, it's typically just the person themselves deciding, you know what, it's worth the spend, it's worth the investment to increase my clarity, reduce my anxiety, and buy back my time. That's really what it comes down to. So it's a very personal decision. I don't think there's really a right or wrong answer. I mean, we see like really sophisticated people just doing it all themselves, and that's great, right? And then they need help in an audit, and that's fine. And we're happy to help them with that. We also see people who are not that sophisticated with way less income, way less assets saying, I'm willing to make the investment because I don't, like, I need to reduce my anxiety. I need to increase my clarity. So I think it's really personal. You know, I don't know that there's definitely an affordability aspect to it. So you have to weigh that. But for me personally, the way that I evaluate purchasing decisions with vendors, whether it's the lawnmower, whether it's an attorney or whoever, it's really just a matter of how much time am I buying back here, and is that worth the investment that I'm going to be making, right? There's always a cost benefit there. So it's really, really personalized decision, in my opinion.
Krista, do you want to ask some of those other investor questions?
Yeah, I mean, just following up on that response, I feel like a big subsect of the over 1,000 people that invest with us, there are some people that are active in real estate. There are some people that are worried about doing their own cost segs. Majority of people are high income earners that want to trust us with doing the real estate, and they want to be passive. What are the benefits of that person using your firm? Like, why you guys instead of another firm that maybe doesn't understand the passive rules as much?
Yeah, I mean, there's a lot of great CPAs that can handle that type of situation. So I don't want to say like our firm's the only one that can do something like that, because that would not be true. I think that what our firm has is just total focus on real estate, and through that also small business. So we can look at your situation and help you very clearly understand how the passive income or losses that you're receiving from your investments work, whether or not you should continue doing that per your own investment style. Like, are you getting out of it what you thought you were going to get out of it? So we can help you with that. We can help you obviously with the K-1 compliance, which gets pretty gnarly depending on what funds you're investing in and where they're investing. But then we can also look at your overall like income situation, whether it's W-2 and use, whether it's a business that you have, and we can help you kind of like understand how to piece it all together. So it's kind of it's a puzzle piece that, yeah, you've got the LP investments, you've got the K-1 income coming in. Maybe that K-1 income's trapped in an IRA or a 401k, which is a different conversation, which maybe we'll touch on here. But the idea is just helping you understand how to optimize all of those investments you're making, how to optimize the money that you're placing, in making sure that you're actually getting out of it what you want. Because a lot of times with LP investors, they'll invest into a syndicate or a fund, they'll put $100,000 in, they'll get the $80,000 loss on the K1 passed back to them, and then that 80K loss gets suspended, and they're shocked. Like they're like, "Whoa, I get zero tax benefits out of investing in real estate." And so what we like to do is sit down and help them understand that they're still getting a lot of tax benefits, even though they didn't get to claim the actual tax losses. Like you still, as an LP, have a slice of this 200 unit apartment building. In this 200 unit apartment building, generated income that you're not paying tax on today because of the depreciation that was passed back to you. Granted, you can't use the depreciation, but there is some cash flow that in most situations was allocated to you that you don't have to pay tax on today. Thus, the tax benefits, right? You're still getting those tax benefits. Sometimes it just doesn't, like, you don't, when you see it on paper, you feel like you were shorthanded. So that's a lot of what we help people do, and then just helping people understand the timing of their LP investments and how to use those suspended losses that are being captured from the K1s, how to use those suspended losses wisely over 5, 6, 7 years.
Yeah, no, that's great. I mean, I think that most people, would find a ton of value in that. They want us to answer a lot of these questions for them, and we're not CPAs. So, that's why we build these strategic partnerships with folks like you to help them along the way. You did kind of provide a natural segue, and I appreciate that, into a question that I think is really important that we've been trying to tackle. And that's the idea of, like, a lot of folks are starting to kind of weaponize their IRA or solo 401k, and they're getting them into self-directed custodians and using that as a vehicle to invest passively. A lot of folks are starting to realize the concept of UBIT and how that can affect the income that they're making. Could you share your thoughts on it, and any strategies you might have to kind of offset that, or the best way to go about it?
Yeah, so the offsetting, there's a natural offset, because you do get an exemption if you're investing through your IRA. You get an exemption up to a certain amount. I think it's $1,000 that you get to just knock off your taxable income, and that helps a lot for, I would say most early investments. But as you continue expanding your portfolio, you can absolutely be subject to UBIT. Now, it can be scary, but it's not. The effective tax rate in practice, at least in my experience, is typically lower than what you would normally pay anyway. So you're still kind of benefiting. But let me back up and explain what this even is. So UBIT is unrelated business taxable income, or unrelated business income tax, UBIT and UBTI. Where it stems from is this idea that it's not fair for a business to use a tax deferred account to run their business out of, because they would in effect they would have a huge competitive advantage over for-profit businesses that weren't using that same thing, right? Like we would all have to pay taxes, and if you were running your business out of an IRA, you don't have to pay taxes. Thus, you have more cash flow to reinvest and grow exponentially larger than I can grow in half the time. So the idea was to prevent this unfair advantage that these tax deferred accounts have. So they added UBIT. Now, UBIT, the whole point is, if you invest in a business that is generating income, you have to pay a special tax. If you invest in a business through your IRA that's generating income, you have to pay a special tax. So typically with UBIT, we're thinking about like flipping or wholesaling or something like that. We're not thinking about rental investing, because rentals are not subject to UBIT. What makes rentals subject to UBIT is UDFI, unrelated debt financed income. Okay. So when we leverage up a rental, meaning that we put a mortgage on it, we put debt on it, that is now income subject to UDFI. So if I've got a 70% loan to value on a property that I purchased through my IRA, then 70% of the cash flow the taxable income that rental pushes to me after depreciation. So there's some depreciation strategies that can come into play here, but the cash flow that rental pushes to me, 70% of that will be subject to UDFI, or will be UDFI, unrelated debt financed income. and that is subject to UBIT. So not all the cash flow is subject to it, but just the percentage equal to the loan to value or the remaining loan that you have on the rental property itself. Now, where it gets interesting is 401ks are not subject to UDFI. So if you want to prevent exposure to UBIT, then you look at, well, how do we create UBIT with rental properties? Well, we create UBIT with rental properties because we're using leverage. It's unrelated debt finance income. If we didn't have the leverage, then rental properties would not be subject to UBIT in the vast majority of cases. So how do I eliminate UDFI? Well, I can invest via a solo 401k because solo 401ks are not subject to UDFI. So if you invest in a solo 401 via a solo 401k, the income coming back to you is not subject to UBIT. But if you invest through an IRA, then it is subject to UBIT because IRAs are subject to UDFI. So I hope the acronyms don't like, you might have to press rewind on this one a couple times, but that's kind of like the summary of it. And then if you really want to avoid everything, invest in debt funds because you don't have to worry about UBIT or UDFI at that point. Interest income is really hard to shelter outside of retirement accounts as it is. So a lot of our clients will use their IRA money to get the debt exposure, a little bit of a safer investment, and there's no issues with UBIT or UDFI.
Interesting. So if you have an investment that's investing in the same types of properties, but it's structured as debt, you avoid UDFI altogether.
Yep.
That's incredibly interesting. Thank you so much for that.
Mm-hmm.
That really wrapped, most of the questions that I had.
Did you want to ask one about depreciation recapture? Or
I mean, yeah, we can touch on that. I think you inadvertently touched on that a few times with kind of the bonus depreciation that doesn't get used. But I guess one of the things that a lot of investors get a little bit confused with is, okay, I utilize my bonus depreciation because I've been in, 15 different, LP investments, and some of them have exited, and I've had this really nice strategy where I'm offsetting. Now comes a day where I don't have any more bonus depreciation. I have all this income, and I'm going to recapture all of this bonus depreciation, recapture at the same time. How do you help people strategize through that? How should people think about that?
So point number one, first off, yes, let me back up. So depreciation recapture, where does it stem from? If I bought that property for $500K, the one that I replaced the roof on and everything, and I depreciated it over the hold period $100,000, the adjusted basis of the property is now $400,000, right? 500K minus 100K depreciation. So 400K is my adjusted basis. If I sell the property for $450,000, most people would think, oh, I bought it for 500, I sold it for 450, I lost money, I get a capital loss, I get the report on my returns. But then you go talk to us accountants and we go, no, your adjusted basis is 400 because you depreciated it 100. Now you're selling it for 450. You actually have a gain of $50,000. Now the gain in this example is stemming solely from depreciation, and that is why they call it depreciation recapture. So gain from depreciation is depreciation recapture. If I ran that same scenario, but I sold the property for 530K, then I would have a $130,000 gain. 530 minus 400K, which is my adjusted basis. So $130,000 total gain. 100K of that gain is coming from depreciation recapture. 30K of that gain is coming from appreciation. Now, if I haven't been able to use the losses that my property has produced in the past, then I could use it at this point up to 130K to offset that gain. If I have used the losses to offset either my other rental income or I offset my W-2 income or regular income via one of those strategies we were discussing earlier, then I've got 130K gain that I've got to face and I've got to pay taxes on. Now, to answer your question, how do we strategize? The first key is just understanding what are you planning to do with your portfolio. So the worst thing that you can possibly do, and this is why we opt into advisory relationships, Samantha, with our clients, because we want to be part of the conversation on an ongoing basis. We do not want to see you once a year at tax time, have you tell us, yeah, I sold this property for 130K gain. And then we go, well, now you're paying taxes on it and there's nothing we can do about it, right? Instead, I want to know now, like, what are you planning to do for 2025? Do you want to sell one of your properties? Do you have a laggard? We look at our clients' portfolios with them and we help them understand return on equity, which is a cool thing we started doing past like year or two. And it's really helped these conversations because we can look at them and say, are you married to this property? Because it's kind of stinking, right? It's like not very good. Well, I don't want to sell because I've got all the taxes. Well, that's why you hired us, right? So let's get a little creative. If we know we're gonna sell something, we can start thinking strategically about how to not pay taxes on the gain or how to kick that can down the road as much as possible. So just because depreciation recapture is a very real thing that you have to plan around, it is something that you can plan around. And there's many ways to do it. There's the 1031 exchange. There's something we like to, I think we coined and like to call the lazy man 1031 exchange. There's a lot of ways to do it. So it's not something to be scared of, but it is something to be aware of, and it's something to plan proactively around. And so that's where the value of having a CPA on your team can really start to stand out in any of those years that you're looking to make moves on your portfolio.
Amazing. Well, on that note, I know you mentioned that you do the advisory and you were kind of launching a new product. Love to hear more about that and how our folks could take advantage of it.
Yeah, 100%. So whenever you work with us, we're going to talk to you about engaging in an advisory relationship for 12 months and also engaging in tax preparation, the compliance piece. If we're doing the advisory, we also want to do the compliance, because why spend all the money on the consulting and the strategy if you're not going to get it into the returns the right way? So we do that. But what we've been doing recently, we've been testing is a service specifically geared towards limited partners. So for a long time, limited partners have hit us up and they're like, you guys sound like you know what you're talking about. I listen to your podcast, read all your social media stuff, read all your blogs, and I really want to work with you. But your advisory price is like $6,000. Can you do anything? And we're like, I don't know. So for a long time, we were trying to figure out like what is an optimal service for limited partners, and can we service them? Because there's just a huge amount of limited partners that are, in my opinion, being underserved by their accountants. So we're slow rolling it right now. I will probably do myself a disservice by talking about any of the details on here because they're probably subject to change. But you get an advisory relationship with the firm, much like I was describing, for a fraction of that $6,000 cost. And then we'll also do the returns for you and make sure that everything's handled, especially on the state nexus stuff, because that's where it gets gnarly. Like if you've got multiple K1s in different states, it can get pretty crazy pretty fast. And in our team, because we have clients in every state, is very, very good at it. So we are essentially, to answer your question, now helping limited partners. And we'd be happy to, if you're listening to this and a limited partner, you're more than welcome to email me and I can get you in touch with our team.
Awesome. Yeah. And we'll make sure that when we post this podcast that we add your links to it so that people can directly contact you as one of our partners.
Thank you.
Well, I think we're going to go ahead and wrap up. We really appreciate your time, especially as you're like a week away from entering tax season. So I know your time is valuable.
I have an amazing team. I will say that my team is phenomenal. So I get to keep doing some podcasts. Yeah, they're great. They're amazing.
Awesome. Well, thank you. And it was a pleasure to meet you. And hopefully one day I'll get to meet you in person at one of these conferences.
Thanks so much, Samantha. It's nice meeting you too.
Thanks, Brandon. Always a pleasure.
So that was a really fantastic interview we had with Brandon Hall. And honestly, I think what I want to find out from you are, what were your biggest takeaways?
Yeah, I think the biggest takeaways are, there are a lot of buzzwords when it comes to taxes and real estate. People know the things they see on, Instagram and TikTok about depreciation and rep status and kind of, the holy grails of how you can offset the most. But the biggest thing that I learned, and I always learn from Brandon when I spend time with him, is having someone that's focused, where their niche is real estate, whether it's active or passive, and understanding all of the loopholes and the way that the tax code is structured is invaluable. And a lot of the things that people go after, like rep status, which is incredibly hard to get, which you saw in the clip, and just doesn't make sense for a lot of people. The time and effort you put into that, if you just work with the right person that knows the strategies, it could really help you go in and out of your overall real estate strategy. It'll save you a lot of money, like a lot of money.
And time.
And time.
That was the one thing that he kept bringing up, which I thought was super cool. He said, no, it doesn't really matter your portfolio size. It really matters how much time do you want to get back, how much time do you want to put in, and how much money do you want to invest in this. And with those key elements, that's how you can really make your decision. Is a CPA right for you? Which CPA is right for you? And how do you actually go about making that decision?
Right, exactly. And especially with the new administration coming in, you know, a lot of people are really focused on, you know, in 2017 with the Trump tax cuts, you saw bonus depreciation go to 100%.
Right.
You saw opportunity zones, you know, flourish. There are lots of things that you would be able to utilize, and you can employ those strategies. But just because you build up a bunch of depreciation, if you don't know how to use it and you're not using it properly and using it at the right times, you know, your whole strategy could fall apart.
Yeah.
So I think, you know, one of the biggest things that you know I appreciate from Brandon is, you know, all of our listeners, whether you're active, whether you're passive, whether you're working with me at Viking, you know, it really doesn't matter how you came to watch this episode. He's offering a new structure within his firm specifically made for LPs. And you know, the active folks might still want to take his advisory services, but that's always been, when I send people Brandon's way, which I send a lot of folks his way, because he's so talented, the feedback I get is, well, Brandon's really expensive. Like, he's really good and he's going to save me money, but he's really expensive. And I think this was a way for him to kind of meet the market and provide the services that people need without all of the extra advisory services that you know some folks really do need.
Yeah. So if you really want to take advantage of this opportunity that Brandon is offering, please either reach directly out to Brandon Hall, or you can go through us, reach out to the podcast on our website, and we're happy to connect you on your behalf.
Absolutely. Thanks, everybody.
Yeah. So this was a great episode. Thank you to Brandon, and thank you to all of our listeners. We'll see you next time. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.